Welcome to the first episode. We are live here at Hedgeye. My name's Danielle DiMartino booth. This is going to be your first deep dive, and boy, put your seatbelt on, get your popcorn out, have a martini in the middle of the day, go for it. I'm here with Lucky Lopez. I even dressed for the occasion. I've been hearing like Eye of the Tiger, and I've been seeing people coming out in boxing matches in Vegas because Lucky is Vegas. Lucky Lopez, thank you for being with me. Welcome.
Thank you for having me. I appreciate it.
You're a car guru, you're a car expert, you're a 20-year veteran. Mm-hmm. You've been around a few cycles, you've seen a few things, and lately you've been making a few waves because you've been talking about, you've been using big words for YouTube like apocalypse.
Yeah, the loan bubble, car market bubble, market indicators, which is my favorite because we always talk about how the automotive market is an indicator, usually 6 to 12 months ahead of like real estate and other ones. So that's one of the things we use. But ever since we started doing this, we just kind of popped and blew up. And you know, I'm very fortunate to be on your show. I can't wait to get into some of this stuff.
Well, you're here because nobody's talking about this. This is like the biggest. This is the best kept secret on Wall Street. Nobody wants to talk about that. Let's do some housekeeping. Let's get a little bit of history out there. In a traditional, prior to the housing boom, what would kind of the order of defaults be prior, when people had equity in their homes? How would they, because it would go credit cards, cars,
and then homes, correct. Yeah, so back in 08, we had that, ninja loans where everybody was buying houses with no down payments and having 4 or 5 with stated income.
Liar loans.
Exactly,
Yep.
But for some reason, the cars was the exact opposite. People were putting 10, 20, 30% down. They're only financing about 80, 90% of LTV, the way it should be. Fast forward to today, and it's the complete opposite. Now we have structure where people have to put down payments on homes. They have to be qualified, but it's the exact opposite for the automotive industry. We have people that can't even afford a $600 payment, paying $1,000 a month for a car financed at 150% of LTV with very little money down. And the scariest thing is no background check.
Okay, Lucky, you just went from 0 to 60. Hold on. So
okay.
that was quick. Got my seatbelt on. So I'm just, by way of background, during the housing crisis, what was really unusual was that we had this thing called jingle mail. And because people had no equity in their homes, they had these 125% LTV mortgages, they just sent the keys back and they kept their cars.
Yeah.
They kept their cars. Now bring us back to where we are today. And, because of the pandemic, we used to say, the minute you drive the car off the lot.
Yeah, depreciation hits, you lose 10, 15% of value right from the get-go. But this is the only time in history ever that an automotive, a vehicle, a depreciating asset is actually gaining in value over the last year or two. But the last 6 months, it's been the opposite. It's slowly going down, and that's what's kind of showing up the red flags.
We're not supposed to talk about that.
Oh yeah, I forgot. But the whole thing that scares me is, I see the defaults, I see the deficiencies, I see the repos coming up, but people are not in a good equity position like they are with their homes now. So I believe that as the market starts to get weak and the economy slows down, people are going to stay in their homes. They have equity.
Yeah.
They're going to start walking away from their cars. Because why are they going to pay $1,000 a month for a Dodge Charger they paid $40,000 for when they can go down the street and buy the exact same car for $30,000?
So how on earth did so many people buy so many old cars? How did that happen? What changed in terms of who was selling what types of vehicles in the pandemic?
So a few different factors that kind of skewed the market. First one was obviously franchise stores. Franchise stores typically by contract have to sell brand new vehicles. They're not allowed to sell.
You're talking about a Toyota dealership or a Ford dealership.
Okay. Yeah. They're allowed to have their used section, but they don't typically sell a lot of used cars, part of their agreement. But when the manufacturers weren't able to supply them with cars, they go ahead and loosen up, okay, you guys can get some used cars to pay your employees to make some money.
Yep.
Well, as a franchise store compared to independent like myself, we have very strict lending requirements where we can only do like on subprime borrowers, maybe 90, 80% of LTV.
Yep.
They can do 110, 120, 130, and with prime customers all the way up to 150%. So they were buying all these used cars way overpriced. Usually as independents, we rely on the dealers, the franchise stores to get trade-ins. That's how we fill our lots. They weren't trading them in. They were keeping them. And they were selling them for above retail. And as they start,
like 100,000 miles.
100,000 mile Toyota Camry, 2015, something that should never be on a franchise store lot is now selling for $18 or $19,995 at 15% interest, and these people are getting financed for like 62 to 72 months.
On a really old car.
Yeah, and then to add insult to injury, they're like, well, this person needs a warranty, this person needs back-end money, the dealership needs to make more, so we're going to go ahead and finance you for 135, 140% of LTV, so we're going to put on a warranty, we're going to put on gap, we're going to put on all this stuff that doesn't really matter, and now these people are sitting in a car that's worth maybe $15,000 and they owe $26,000, $27,000 on. And at a 15% interest rate, even if they make their payments and they're good and they rebuild their credit, they can't go to any credit union to refinance. They're stuck in this car.
This is like better than the Federal Reserve. Like dealers were printing money.
Yeah. Yeah, there was the Wild West. Every dealer was screaming, oh, it's because of inflation. We need more money. We got to borrow more. It's inflation. We got to hedge against it. And so the banks are like, okay, well, we're getting money from the government. Let's just go ahead and start giving people 150, 160% LTV. There was one bank, I remember iaai, when I bought my car, would go up to 162% if I wanted to buy a warranty, finance on my sales tax, and put zero money down. And I got 2.9%. And yeah, and so instead I put 30% down. I financed it for 60 months, didn't want to go 84 months.
Yeah.
And so now it's funny because the whole market is collapsing and they're backpedaling. And as we start to share indicators, like I don't want to get too far ahead of myself, but you know, one of the biggest things is the banks. The banks always try to outrun the risk. So as these repos started hitting, as people started becoming late, they started panicking. So the 84 months is gone. A lot of banks are going down to 72 months.
So the credit box is, as we would say, contracting right now.
Yes.
Tell me about the CARES Act, the STEMI checks, the income verification, how that changed, so to speak.
Yeah, so traditionally,
the credit box got real wide.
Yeah, it blew up. So normally if, let's say you worked a regular job and you went from, let's say you were a waitress and you were making 15 bucks an hour, and now you just got your degree and you're a, I don't know, a veterinarian. I can justify to the bank, hey, look, she's going from a $20,000 car to a $50,000 car because of the increase of pay due to her degree.
Sure.
And so that's how we justify, that's how we paint the story for the banks to buy it. Well, during the pandemic, they didn't ask any of those questions. Traditionally, if you had a boom in income and you didn't change into a profession, they would want 6 months of bank statements and they would basically balance it out. Okay, well, she made X amount of dollars for the last 6 months, so we're only going to approve you for this amount alone. And so instead, banks were like, well, they're making, you know, $4,000 a month, their spouse is making $4,000, the household's $8,000 a month. Let's get them into a $1,000 a month payment, you know? And, you know.
That $4,000 a month was taxpayer money.
Yeah, temporary money, not even theirs, and somehow they were able to bypass all the regulations that I had to deal with for the last 20 years, and now it was the Wild West. People were out giving out loans. We were financing stuff that we'd never financed before.
So you were telling me about this one example of like in back on planet Earth, if somebody was like living like in a temporary type of month by month type of situation, so doesn't qualify for a 6-month or a 12-month apartment lease,
Correct.
let's say. That person would have never qualified before.
Correct.
And yet he was able to walk in and buy a car, finance a car.
Yes.
Okay.
Yeah. And it's just the government kept saying, "Oh, don't worry about it. Just keep lending." You know.
So this is the government expanding the credit box?
I think it's because I honestly believe it was because, I hate to say bullshit aside, every bank that I knew was just like, give us more loans, get us more loans. Because one thing I told you, I go out and I buy loans from other dealers, and they were like, just get more, because the government was buying everything that they were shoveling down their throat. And they were just selling it off to everybody because it's just that when there's free and cheap money, credit runs free. And in our business, it's the worst because there is zero regulation and everybody just has their fun with the market.
Just maintain that loan origination volume, just like subprime.
Exactly.
Just like the mortgages. Fabulous. Because you can always sell it, right?
Yeah, correct.
Okay. Who's selling it?
Everybody is selling it.
Define everybody.
Every bank that I deal with, there's a lot of companies. There's not only regular banks, but there's just loan origination companies like online, like Lending Tree, stuff like that. That will you go apply, you get your loan, you give me a check, and then they bundle it and they hire either brokers like myself to go get their paper and sell it to either other banks, Wells Fargo, Bank of America, some private individuals, hedge funds, stuff like that. And that's pretty much what we do. We buy the paper, we look at it, we give it a rating, and then we sell it off to them. And if they amortize it, then they get their own BS rating, and then it gets sold off to the public, which is awful.
And these are rather large players.
Yes.
Iaai is one of them.
Yeah.
Carvana's got its own.
Yeah, they have Bridgecrest. They tend to stay to their own paper because I think their little Ponzi scheme is making money their own way. So I won't go into that one unless you want to. But
I think the Carvana. I think that dog is dead. So
yeah, and so but a lot of these it's mostly private money and hedge funds because the typical returns they used to get during a bull market, they don't want to lend in anything else. But now that the market's scarce, people are not making those returns, they want to get 10, 11, 12% on their money. They come back to the subprime market, and they're the ones that are buying a majority of a lot of this subprime paper because of the interest. But that's one of the things we talked about, how this type of, I guess, lending skews all the demographics for like repos for late payments, which I don't know if you want to roll into that.
Yeah, I mean, so let's get into, so just so we paint the picture. People who couldn't and shouldn't have qualified to buy cars could buy cars. And they could buy really bad cars with really long terms and high LTVs, and then the dealers rolled in all kinds of stuff to make extra profits.
Correct.
Got it. What would they do after they got the car? Some people. How long did forbearance go on?
Oh, so
Because that was that was the other thing the government was saying was sell them the cars, but don't make them make the payments.
Yeah, so they were literally giving out these loans, and we were getting emails from like some of these lenders like Capital One, some of these local credit unions, larger banks, Ally, Wells Fargo.
Yeah, credit unions are big in this business.
Yeah, you could call them and be like, oh, I just got a car, but because of the pandemic, I can't make my payment. So I just got $20,000 from the government, gave half of that to a dealer, and now I'm calling you telling you I can't make the payment. And they didn't really care because they all had those forbearance programs. The government's going to bail me out. It's okay. We'll just kick that can down the road and we'll deal with it as they went. So a lot of these people had these cars for almost a year before they started paying.
And some people still haven't started paying. So this is what blows my mind. I think I misunderstood you. Are you seeing cars on repo lots with paper tags?
Yes.
From 2020 and 2021?
Yeah, that's the most alarming thing. Yeah, like we talked about how when I started talking about the repo rates booming up, and I got all the skeptics, no, they're not, and the repos are not up. And I told them, one thing that I've noticed is all the loans that originated from 2020 and 2021 are having a double or if not triple the default rate of other loans. Because back in 2018, 2019, those people traditionally got their cars. They're not letting them go. They're in a good equity position, just like houses. But you fast forward to 2020, 2021, at the peak of the market, these people are overpaying. They couldn't afford it. And so now as we start to go to these auctions, we're seeing cars with paper tags. Cars that were purchased over 2 years ago never registered because they couldn't afford to put the tags on them. And a lot of the banks now are starting to go after the consumers because they're not registered, which is part of their agreement. They have to keep it registered and they have to keep it insured. So if they don't abide by the rules, they don't collateralize their property, the banks are allowed to repo it depending on which state they're in.
Well, you would think so.
Yeah, and so now these banks are starting to scare because they're seeing the prices, used car prices go down. They're seeing their collateral out there with not being protected.
Let's pop used car prices up on the screen for everybody for just a second, just so we can see what 2021 looked like versus how 2022 is getting off to a start. Just a little bit of a difference, people.
Yeah.
So just for a little bit of vocabulary here, retail versus wholesale, because there are two lines there.
Yeah. So usually it tends to be about 10 to 15% of what the dealers make on a car when we buy it wholesale at the auction, and we turn around and sell it to the consumer. But if you look at this graph, it's the exact opposite. Their dealers are paying more for it at the auction, and retail is actually going down. And so when I see graphs like this, it makes me laugh because a lot of consumers are like, well, I haven't seen a price drop. I haven't seen the market fall out. And I keep telling people it's not going to fall out. It's going to be a trickle-down effect over the next 6 to 8 months. Prices are steadily going to go down. And as the lending, that's the key. It's not the used car prices. It's when the lending dries up is when the car prices are really going to start tapering down.
So it's with good reason. You did a great video. You flew some drones over some massive. So this is my biggest takeaway. You flew drones over lots in Las Vegas that were not being leased because in a plain vanilla recession, if you're Joe Repo, you lease overage lots, you get through that worst part of the recession, the repo cycle comes and goes, and then you go back to regular volumes.
Correct. Yeah. So like in 2015, we would lease. But now, all my friends are out purchasing properties. They're purchasing brand new trucks that are being made right now to come out in the next 6 to 8 months because we believe that it's going to be a 2 to 3 year thing.
Repo trucks.
Repo trucks, and we're talking acres of property in multiple states because they believe it's going to be that big. Because once the market starts to collapse, I don't think people understand this, is when you file bankruptcy on like a house, your house just sits there. But when you file bankruptcy, you have some other pending legal matters. We have to sit on your car for sometimes months, sometimes a year. So during the 2008 fallout, I saw acres and acres of cars scattered all over Vegas, Phoenix, LA, just full of cars because there's so many bankruptcies. Now, I don't think it's going to be as bad as 2008, but I think that what's going to happen is a lot of people are going to walk away from being upside down in their cars, and it's just going to feed that that repo basically slush fund. One of the things I talked about in my video was when we go to the auction.
So somebody's going to make a lot of money here.
Yeah, somebody. We're trying to figure out how we can, like we talk about, short the market and figure out what there is. It's a little more complicated, but one thing that I've noticed is that going to the auction, as I'm watching repos piling up, defaults are going up. People are scared. People are starting to notice this, and that's how I knew that we were on to something. Because when you first reached out to me, it was just a video on YouTube, and then the Barron's article. A few other companies reached out to me, and a few other hedge funds, and now people are talking about it, and that's why I think this video is going to age great.
A guy on YouTube read the Barron's article out loud. That's all he did. Read it, word for word for word, 100,000 views.
Yeah.
I'm like, why don't I think of these things? I need to be younger. Anyways, keep going.
Yeah, but no, I think this is what's going to make this interview so great once we post it on our platforms.
So, all right, no sale.
No sales, yeah. So,
what's a no sale?
So as these repos that I showed in the video were piling up, they're running through the auction. Now, during the pandemic, we had maybe a couple hundred cars. Usually we have 2,000 to 3,000 cars running through the auction. But what's happening now is we're up to, back to pre-pandemic numbers. We have a few thousand running through every week. And the problem is the banks are so into these cars because they borrowed so much money, they keep running through the auction. Well,
they're upside down.
Yeah,
the banks are upside down.
They're like, well, this customer owes 40. Retail or wholesale is like 35. I want 37. And dealers like me are like, we're paying 33. We're paying 32.
Yeah.
And these banks don't want to eat that deficiency. So they say no sale. And then next week, it runs again.
In my world, we would say the banks don't want to realize the loss.
Yeah, and so now they're just like, well, we're going to kick the can. There's going to be somebody, the greater full theory. There's going to be a greater full next week that's going to pay for it. It's not happening. And so we're seeing this snowball accumulate where there's more and more cars because typically, these cars get dropped off at the auction, they run through and they get sold. But that's why we're starting to see storage yards in certain states and cities because they can't bring all the cars at once, because if Wells Fargo drops off 3,700 cars in one market and floods it, the prices are going to go down. So now they're kind of holding the supply and letting them trickle out and try to keep the prices somewhat high as demand starts to taper down.
So I've heard that they're even moving cars around the country.
So we made a video joking about how the East Coast up here, used cars are a lot harder to get. They're still holding their value. So a lot of them are going from the West Coast to the East Coast to fill up the auction houses here because they're bringing more money. So for them to ship it $800 and to get an extra maybe $1,000, $1,500 in the back end will save their books. But it's it's something that typically we don't do in our market. Like, why am I going to ship an $8,000 car for almost $1,000 to save $1,500 here on the East Coast? But there's such a demand in certain areas, and that's one thing I think that skews it is we talk about looking at the broad picture. I always get these people, well, in my market it's hot. Then you hear other people, I haven't sold a car in a week, my market's slow. And so I want people to really sit and think about this interview and start looking online and reading the conflicting reports. Like you brought up one the other day that was really good, how it shows the repo rate is magically like going down, but the default rate is going up even higher. So, I had a lot of questions on that. They're like, well, how do you explain this, Lucky? This doesn't make any sense. If repos are going higher, I was like, it's forbearance programs. Banks are realizing they can't get the money that they could at the auction. So
they're quietly doing this. They're working with people.
Yeah, and so now they're like, okay, well, normally we repo it after 30 days. Now we'll give you 60. Now we'll give you 90. I heard one bank going all the way up to 120 days. Some were just adding on months at the end of their loan and recontracting them. And that's how I know that we're on to something, because once I started hearing conflicting reports in the news and then banks kind of backpedaling, trying to figure it, because I know how they work. They always mitigate their risk. Every quarter, every month, banks will issue new lending parameters to offset their risk. And so usually we get these, like I said, once a quarter. Now we're getting them every month. Oh, we can't lend this much LTV. Oh, we can't do 72 months. We can only do 60. Oh, we can't do luxury vehicles anymore. We have to do regular cars, American, German, Korean. That's it. And so it's like they're backpedaling and shrinking their lending parameters more and more to offset this risk and default.
So this isn't even really a phenomena of rising interest rates at all. That rising interest rates really has nothing to do with this.
Yeah.
Because if you look, 0% financing is actually going up.
Yeah.
Right now. But this is a function of they know that the credit quality is getting worse, and they know that they've got more risk sitting out there that's unrealized, more losses that are out there that are unrealized.
Yeah, and then now that the cost of money is going up, they can't take that type of risk. The only lenders that are going to still do really crazy lending are ones that have the incentives. So like Ford Motor Credit that finances their own cars, Toyota Financial, Lithia, there's another one. There's a lot of these banks that are realizing that, well, these other banks are not buying the paper. We're just going to buy it. We're going to do the loans. And now they're getting their asses handed to them. Now they're like, oh, okay.
Yeah.
Because I think Lithia borrowed, I may misskew, but I think they borrowed or raised another $100 million to keep as collateral protection just in case the repo rates get out of control and if their deficiencies get too high so they can maintain their portfolio.
Cushion, yeah.
Yeah, and so now that I'm starting to see this, it's kind of making me laugh because it's like we talked about this 6 months ago and now it's like it's starting to get more aggressive and I think that it's going to get much worse here in the next few months.
So why, can we flash up on the screen the Cox monopoly? I said it, I gotta say it.
Yeah.
Why do we hear a constant drumbeat narrative that the market, whether it's used or new, is so strong? Can you walk me through who all Cox owns and the different stages of me, the consumer, buying a car and where they touch that process?
Okay, so Cox Automotive is obviously the biggest automotive company in the United States. And we'll start off with the first one, which is Manheim. Manheim is the largest auction in the United States, also in Canada, and they're in Mexico as well. And what we do as a dealer, this is where we go buy our cars. They have a thing called MMR, which is market value for used vehicles. And guess who generates this number? Manheim. They say that, this car is worth this much because this is what people are paying for at the auction. So every time somebody overbids, Manheim keeps that volume high and keeps that number high, and that's what me as a dealer is forced to pay. So every time I'm like, I don't want to buy this car for this, they always say, well, that's what MMR is. You got to pay MMR. So now we fast forward to...
Because MMR just was it was 70%-ish in 2020, 2021. It's come down to 50.
Yeah, it's dropped big time, and every month it's dropping another point and a half. And so it's like we're slowly seeing it taper off. The next one in that chain is Kelley Blue Book. Now, a lot of people use this as a guide for figuring out, pricing on cars. A lot of lending institutions all across the United States, that's how they actually lend on vehicles. They're whatever Kelley Retail and Kelley Wholesale Blue Book, whatever X amount of percentage points above that, that's what they lend on the vehicle. So that's one other thing the Cox Automotive controls. And then now let's fast forward to the consumer. If you look up on the screen there was Auto Trader, and I think there's two other ones.
Yep.
Both of these, we have Dealer.com, DealerTrack, which is the finance thing that us dealers use, and vAuto all tell us what the consumer is supposed to pay. And so now you're online, you're looking as a consumer, and you're like, well, Auto Trader says that this is a good deal because Cox Automotive said so. So now we have Cox Automotive that tells me how to buy it, Cox Automotive that tells the bank how much money they got to lend on the vehicle, and then they tell the consumer how much is a fair price. And so I don't know, I'm kind of skeptical on the definition of a monopoly, but I don't know how much more monopoly you can get besides this. I mean, they
they tell Wall Street the car industry's just
great. It's
fabulous.
Yeah, it's booming.
It's just a chip shortage. How many times can you read it's just a chip shortage when you hear from South Korea that, we've got too many damn chips. We don't know what to do with all of them.
Oh yeah, I remember doing this on my channel. People were skeptic and they'd throw the chip thing in my face. Lucky, the chips, you gotta, there's a chip shortage. I'm like, do me a favor, call any Chevy dealership, and I even challenge your viewers to do the same thing. Call any Chevy dealership, say you have a 2021 Chevy Corvette and your PCM or your brain, your computer is burnt. You need to order a new one. Guarantee you'll have one within the same day or the next 2 to 3 days. There's not a chip shortage. I'm so sick of this, there's a chip shortage. Every single smartphone, every iPad, every gaming system runs on the exact same chips. And they all come out of, I think it was Taiwan and like 3 other companies. And there's no shortage. And so when I hear this, I always go back to the franchise stores and tell them, if you're Ford and you're making record profits, and you're producing, let's say, just a generic number, 100,000 brand new cars, a year. Why would you double that to get back to pre-pandemic numbers just to break even or lose money? I would just make less, keep demand high.
That's so. This is you're describing the Mary Barra philosophy.
Yeah.
So she has committed to shareholders. I'm going to hold inventory back. I'm going to maintain profits on these cars. We're at all-time high prices. So rather than roll out incentive spending, I'm just going to hold back inventory. Isn't that going to have a trickle-down effect to factory workers, dealers?
Yeah, I mean, it's going to hit everybody across the board, especially if you're a loyal Chevy fan. If you want the new Chevy Corvette and you can't get it, now you're going to go look at other options. Maybe you're going to look at the Mustang. Maybe you're going to look at a Nissan 3 or 400Z. You're going to lose market share. They all keep thinking like, oh, well, the market share is going to be there. We're just going to keep our profits high. But all of a sudden, if you're in the economy sector and you're getting beat out by Hyundai or somebody else, it's going to hurt, and your franchise dealers are going to be upset. I think a lot of franchise dealers are going to start suing a lot of these manufacturers because they're not getting the vehicles that they're promised. They're, as a franchise store, we have to buy a certain amount of cars, we have to uphold a certain rating, X, Y, and Z, and now the franchise stores are like, well, we're going to keep supply low, and we're going to figure out how to do our direct-to-consumer model, but in the meantime, we're just going to give you the scraps, and then you can grossly overcharge your customers and make money. And it's funny because both Ford, Chevy, Honda, Toyota, and Hyundai both put out memorandums saying that they're going to start punishing dealers that charge $20,000, $30,000, $40,000 over MSRP, and I'm still waiting. It's embarrassing.
I'm still hearing the anecdotes that people, if they've been waiting for a car for a long time, they're still paying over.
Yeah.
And so they said that they were going to slap them on the wrist. They haven't done anything.
No. I mean, I've been trying to buy a new Ford Bronco for the last 8 months, and every time I go there, I was like, there's 10 here on the lot. Well, we want 20 grand over sticker. I'm like, no. I'll pay MSRP, not $1 over. And now it's funny because every week I go by, I see another one. And I think that people are starting to realize that people are catching on that it's not this shortage, it's not this big dwindling. One of the funniest things I saw, which I'm making a video here soon, but I want to share with your audience first, is if you guys are car shopping, do me a favor, always drive to the back of the dealership. I always hear, hey guys, we only got 10 models of this car left. There's a shortage. You got to buy these 10 cars. You drive to the back of the lot, there's 30 of them just sitting there. You can pick whatever color you want. And so it's the same BS thing over and over and over again. And it blows my mind. And I come here on the East Coast and I see the deficiency with franchise stores. A lot of these stores are smaller, so they may buy 100 trucks a year. They only get allocated maybe 3 this month, but like these massive dealerships we have on the West Coast, they get 2,200 trucks a year. They're getting maybe 30, 40 trucks a month. So that's when I hear people on the East Coast like, I don't understand it. There's a shortage here. You go to the West Coast, there's lots like in Vegas. You go to Sahara Dodge, it's full of freaking brand new Dodge Ram trucks. Most is one of the desirable trucks, lots full of them. So,
all right. So let's go to Vegas. Let's go to The Hangover. So you remember that scene where they wake up and somebody opens the bathroom door and Mike Tyson's snow tigers in the bathroom. So can we flash up the PPP loan from somebody from the great state of New York who actually has no fear of ever getting audited, ever? This thing's been trending on Twitter. So walk me through The Hangover. Walk me through the Rolls-Royce example because it blew my mind.
Yeah, so one of the things that I do is I go out and I purchase repos from banks. And every once in a while, I get to look at the actual documents on how much they owe. That's how we figure out our pricing and everything else. And some of the bankers were telling me that all these exotic cars that I was out there purchasing all had one thing in common. They all had PPP loans with this exact same bank. So they would get a PPP loan, month, 2 months before, and then magically they would have $50,000, $100,000 down for Rolls Royce, Aston Martin, Lamborghini Huracan. And all these cars, none of them were registered. I think the Rolls Royce was the only one, but he was using it as a rental car because he couldn't afford the payment. So he went from getting, I think, $400,000 or $500,000 in PPP loans to buying a Rolls Royce, taking it repo because he was 4 months behind and wouldn't make any of his payments.
So what should you have paid for the car?
Car was worth close to about $320,000, $360,000.
And because it was rented out every weekend in Las Vegas, because I'm sure people take really good care of rental cars in Las Vegas. How much did you pay?
Actually, it was less than the 180. It was 152. And so we got it for about 50% of book. And the reason why we're able to do that is because those particular cars, if they're not pristine, they're not going to sell at the auction.
Right.
And these people should have never had these cars, just like the people in the subprime market.
Yeah.
So everybody feels like, oh, this is only a subprime thing. This is, people that don't have adequate income. This hits all aspects, all spectrums of finance because, we're talking people that were business owners that were somewhat legit, that got some of that free government money, that just ran away with it. And that was a perfect example. It blew my mind. And the sad thing is,
some of these people are crossing state lines.
Yeah. Yeah, they're all going in different states. Like we're actually getting ready to go to Texas. That's where we're going there next week. Same thing.
Come on down.
There's 4 or 5 cars that they got a PPP loan for a restaurant in California. They got it shut down because of the pandemic. But then when they got audited, it's like, where'd the money go to? Now they're moving into Texas. So the cars are down there somewhere in Fort Worth. So we're going to go find them. But same thing. They put $200,000-$300,000 down on each of these cars. Cars that they should never even have owned. And they're not even renting them out. They're just a family that has a group of exotic cars. So it's literally no payments, excess, nothing's registered. They told me that none of them are registered. They were tier 1 customers because they put such a big down payment. So there's no GPSs in the car, so it's a crapshoot. So they're not.
This is like bounty hunting.
Yeah, and they're not insured. So now it's this is what we're seeing. This is why I keep throwing up the red flag. Like, the prime market is the one that scares me. On my video we talked about how the prime market went from 2% defaults to 4%.
Yeah.
And I'm like screaming from the hilltops, this is really bad. Oh, 2% to 4% is not that bad. I'm like, it's double. If you're used to 2 and it jumps to 4, that's double what it normally is.
And it's prime.
Yeah, and it's prime.
And you're not. So it's funny you mentioned Texas because during the pandemic, I understand that my former employer, the Federal Reserve, printed a lot of money and people made a lot of money in a lot of different ways. But overnight, everybody was driving a luxury car. I mean, overnight. You couldn't look left or right. And not even kind of in the usual, this wasn't just like Highland Park Village in Highland Park, Texas, where all the cars were always nice. They were everywhere. Yeah. And I'm like, who's affording all these cars?
Yeah. People like all of a sudden, hey, I got $20,000, been waiting 4 months for my stimulus check. I got $15,000 at once. What are we going to do? Let's put 10 grand down on a Lexus that we can't afford. Here we go. And it's like everybody jumped on that bandwagon. And, it makes me mad because a lot of people blame dealers. And I always tell people it's not the dealer's fault. It's the car business is 100% consumer driven. If the customers are buying and they're overpaying, then guess what? We're just there to facilitate it. The banks were just kind of fuel on the fire. So, during this whole time, people are like, we should hold the dealerships accountable. I'm like, it's the customers. Nobody held a gun to your head and said, buy this car. Nobody told you to pay 15, 20% interest. And nobody told you to take that stimulus money that you should have paid your rent and stiff your landlord and buy a car that you can't even afford.
Well, they didn't have to pay their landlord.
Yeah.
That was covered too.
Yeah, and so now it's like everything's coming back to roost. We have inflation that's out of control. We have people that the rents have doubled. Fuel has obviously tripled, and everything else. And that's why I think the prime market is the biggest indicator of what's going to happen because people are like, well, subprime. But the prime people can't afford it. They may have been able to afford
and
that.
they're not making their student loan payments either. I read this report that was like had a revolutionary finding. If you did, 80% of Americans who haven't been paying their student loans have seen their FICO scores improve, and I'm like, no shit, really?
Yeah, they get more money to pay other things.
Exactly. Of course, their FICO scores improved, but if anybody had to make all their obligations, forget it. It's just not happening. And it's certainly not happening in a rising layoff environment, which is where we are.
Yeah.
And we're not really seeing it in the jobless claims data. These people are getting severance packages.
Yeah.
Which will hold them out for a little while. But then they're going to be like, why did I buy a house in the exurbs? Why did I buy an expensive car? Now my boss wants me back in the damn office. So now I'm commuting back and forth with gas prices, which have come down, but they're still high.
Yeah.
Food prices are insane. I miss my life in the city when I could just get on the subway.
Yeah. Yeah, and I'm glad you brought that up because that's like one of the things I told them why prime is going to be hurting, and that's why this is a bigger issue than what people are talking about because they may have traditionally been able to afford that payment, but like with the rent, a lot of people losing their jobs, the economy kind of staggering out. It's just a recipe for disaster, and it's funny because the more we talk about this is not science. We're not going really deep in the numbers. Just basic common sense of economics. Hey, these people can't afford these cars, inflation, people losing their jobs, the economy is slowing down. you know, and the vehicle values are going down. They can't trade them in. Like that was my video last week is we talked about how, well, people could just get rid of their cars. I'm like, they can't. Nobody's going to refinance them because they're upside down.
Right.
A lot of these people, you know, when they start to become late, their credit kind of goes to the wayside, and
they're out, as far as they're concerned, they're out in the middle of nowhere.
Yeah.
Where they moved.
Yeah, and it's like, well, I work from home, or I got some sort of online job, and they don't qualify for traditional financing.
Yeah.
So the banks are kind of gone back to the way it was in 2019. So now they want to see bank statements, pay stubs, W-2s, some sort of proof of income, some sort of track record. And you got all these people that are like, well, I'm working from home, I'm an entrepreneur, I'm whatever, I'm a crypto trader. And now they're literally all getting, I hate to say the word, just literally raped by the banks because they have no choice. They have to sit down and take whatever interest rate they give them, whatever payment they give them, and they got to do it. And they're stuck.
So how bad could this get? Somebody who runs the Las Vegas Repo Association, blah, blah, blah. He was in an article a few weekends ago and said that on average nationwide, that Repo is seeing 15,000 repos a day. That number seems a little big.
I think it is, but I mean, I think I know where he's going with this. Like, it's going to get ridiculous. Here's where I see the path leading, and this is why it's such a big deal.
Because the biggest year was what, 2.5 million in 1 year? 2.4?
Yeah.
Okay, so that's your baseline. Because 15,000 a day is like double that.
Yeah.
So I think I don't think we're there yet. But why does he think we might get there?
It's because what we're seeing, as we start to see the defaults hit, banks notify us. Usually with repo companies, they get a list every week. So they're all signed up on the same software. So a lot of these repo companies get a multiple list from multiple banks every week updating new cars. And their job is to go out and search for these vehicles. So they have a rate where, you know, like, well, if I have 60 new repos every week, I need 2 drivers and 1 spotter out there all the time. This is why they're going out looking for more trucks, more spotters, and more property, is that number has jumped to like 150, 160. So now they need 4 more trucks, they need 2 spotters, and they need another acre to 2 acres to put all these vehicles in.
Well, from some of the headlines I'm reading, they also need bulletproof glass.
Yeah.
Like, these guys are getting chased after with people who are packing. I'm like, whoa.
Yeah, and I think as the economy starts to drive down, we're going to see that disparity really hit where people are not going to give up their cars. They have no more free handouts from the government. They don't want to go back to work, which sounds bad, but that's just the way it is. And so now all these things are going to culminate in the one thing that's just going to spell doom and disaster. And I feel bad for like these credit unions and smaller banks, because when people laugh like, oh, well, the banks deserve to get, you know, taken out, they deserve it, they're greedy, you know, auto dealers. And I'm like, no, it's your small mom and pop credit unions that were competing with the Wells Fargo's, Banks of America's. They can't take those big, massive deficiencies when those cars hit there. So guess what happens? Now, maybe your local community doesn't get the home loans they need. Your small business owner that you've loved for 20 years that maybe it's a bakery in your small town, can't get a business loan or lines of credit. All this will start hitting the banks, and as they get that deficiencies, they got to figure out how to offset that risk. So they stop different funding programs, they stop doing credit cards, they stop doing different types of loan approvals. Businesses, totally out the door. And that's why I keep telling people that this is
there's a domino effect, and credit's going to tighten because of this.
Yeah.
And you're right, credit unions have been knee deep in this business, and they're starting to set aside more and more for loss provisions right now, and we're seeing that increasingly with earnings reports. On the Wall Street side, we're also seeing the highest rated paper, AAA paper. Why are you laughing, Lucky?
It makes me laugh, yeah, because it's like when I go out and I sell this paper, part of my job is we look at it and they ask my opinion is. And the way it works is when I sell paper, not only do I get a commission when I sell it, but I also get a performance commission. And I don't want it to be based off of, you know, bad paper. So a lot of these people are like, oh, it's AAA rated paper, it's the best paper. So I'm looking at it and I'm like, okay, here's a customer that makes $15 an hour and a $40,000 car with a $1,000 monthly payment, and the vehicle's worth about $28,000 to $30,000. How is this AAA rated? He makes all of his payments. Yeah, he makes all of his payments now. I go, once, you know, he has to pay higher rent. Once maybe he loses his job, he can't afford to float this. This is the type of consumer that doesn't have 6 months of reserve, and he's going to be buried in this $1,000 a month car payment. That's absolutely ridiculous. And so when I look at this paper that they quote unquote say is triple rated paper, I'm like, who's grading this? I swear to God, they just look at it and be like, oh, these 3 people make their car payments, and these 1,200 people, they make their car payments on time. let's just bundle this up, amortize it, AAA paper, here you go. Give this to all your hedge funds. Let's give this to somebody's retirement fund because you're going to make 11% off this.
And even
have
so,
fun.
I mean, that paper's gone from 20 basis points over to about 85. Forget triple B.
Yeah.
That stuff's, I mean, at least the streets figured that out. They're like,
Yeah.
that's toxic. It's like green.
And I'm glad you brought that up too, because like we talked about a lot of these repo numbers and bank numbers being deficient, because every time I talk about repos, people's like, where's the data? So I included it in Equifax's proposal and showed each state by state, how high their deficiency rates are. Hopefully you guys can put the link in the video.
Oh, yeah.
And it's like, that's the data, but everybody keeps asking me, when's the next update coming? I'm like, it's not gonna. The banks don't want people to know.
That's the wild thing. So as of September the 30th of 2021, which may as well be a dog year ago in the ice age.
Yeah.
But as of September 30, 2021, 23.4% of people in Washington, D.C. were at least 30 days delinquent on their car loans.
Yeah, highest in the nation.
Washington, D.C.
Yeah, Washington, D.C., land
They
of...
knew how to game the system. God love them.
Yeah.
And then it's right after that, you go into the traditionals, the Deep South, Mississippi, but Texas is up there. Nevada's up there.
Yeah, we're always up there, unfortunately. But,
Yeah.
and so when we explain this to people and we talk to them like, hey, this is what's happening. This is why there's so much deficiencies. And they're like, well, I don't see more credit ratings. Why don't people share it? And I tell people when we sell paper to like hedge funds, private individuals, like if you said, Lucky, I need to make 10% on my money, I got $5 million, can you go buy some paper? So I go buy some paper from some automotive dealer and I sell it to you. You're a regular person. You're not regulated by FDIC to report late payments, repos, a lot of the stuff. So all the numbers that you guys are seeing that you're like quoting is completely skewed. So every time I go out and I go buy paper, I get to see how much they owe. Is it even worth it? The deficiencies, the bankruptcies, everything. And so...
And you can also see that by the same way that they open the credit box for car loans, they open the credit box for other kinds of credit for these borrowers.
Yeah.
So it's not, it's personal loans, it's credit cards. I mean, it's all kind of related, but not in a good way.
It's very 2008-ish.
This is like Appalachians incest type of related. This is bad.
Yeah. I mean, the last time I saw this much cross-collateralization was 2008. Yeah, exactly.
All right. We got questions. We've got questions.
Okay.
What are the best ways? See here.
Best ways to short?
We were talking about this at dinner last night. How do you make money? And that's I think Wall Street's so frustrated because they're like, it's a $1.4 trillion market.
Yeah.
There's got to be a way to make money on this.
Do you want me to do the hot potato thing? Explain it?
Yeah.
Or? Okay.
Let's do hot potato.
So everybody's asking me, how do we short this? How do we make money from this? Here's the problem. Banks are a lot smarter than you and I. I don't care how smart you think you are. They're always 10 steps ahead of us. So when we're lending money, every quarter we have to lend out X amount of dollars. If we don't, then usually what they do is they tend to buy paper from other banks. So let's say you're Bank A and you got $100 million a quarter to lend out, and all of a sudden you're at 90,000. You're like, oh, we got $10 million. Let's go to Bank B and let's purchase this $10 million of auto loan portfolio to put on our books, because if they don't lend out all that money, the next quarter they won't get the same or even more what they typically need. They need to grow that snowball.
Yep.
So they're constantly buying paper from each other. So what's happening, and I explained it as musical chairs or hot potato. Every bank, imagine just a group of banks like Wells Fargo, Bank of America, some subprime banks and hedge funds, everybody's pushing the paper around to each other. And basically what we're heading for is the aha moment, when defaults start hitting the bottom, when there's at least a 10% gap in actual value depreciation, and the vehicles are not what they're supposed to be worth. That's when whoever's left holding the bag, when the music stops, that's the bank that's going to be held to all the regulatory penalties, regulations. They're going to be the poster child for...
Some regulator's going to say, get that shit off your balance sheet now.
Yep, and they're going to have 2 years where they can't lend anything, and it's going to be like 2008, all the subprime banks jump back in that are new, they can go out there and start lending. And that's one of the reasons why I'm trying to get back into it too, because I know there's going to be a huge market. But that's what's happening. So every time when I hear people like, what about Wells Fargo, can I short them? No. Credit acceptance? No. I was like, these guys are literally pushing paper back and forth. So every time
This is just like private equity. They sell companies back and forth to each other at higher and higher valuations.
Yeah, and it's like, and as soon as now that these banks are kind of aware of it, and they're seeing people talk about it, and hedge funds are reaching out, and people are like, oh my God, I think there's something there. As soon as there's smoke, they're already selling. Like, usually I get calls from banks wanting to buy paper, because always like they want to buy more and more. Now it's been mostly sell. They want to sell their paper. They don't want to buy it.
That's not a good shift.
No. So now they're like, do you have anybody who wants to buy $10 million, $15 million? And I'm like, just send me the paper and I'll look at it, And it's funny because now people are starting to realize that, the music's, it's starting to quiet down and it's slowing down. So it's
That's called
gonna
a
stop.
haircut. Yeah, I'll talk to you for a haircut.
Yeah.
All right, so what kind of cars are being repossessed most? Somebody's asking about trucks and SUVs.
So here's the catch. Trucks and SUVs are always going to be the lowest amount of vehicles repo because they tend to go to working people, and most of them use them for actual, for their work. So they tend not to do that way. But they did take about a 10 to 15% hit at the auctions because of gas prices and rising insurance costs. So in the next 6 to 8 months, you should be able to get a good price on a truck, especially if you're getting a diesel.
Especially if you're getting a diesel. Well, yeah, God, that's been the worst. So what do all these economic and financial factors regarding the auto market say about the current economy and the short-term future of the economy? What does this tell you about the U.S. consumer?
This tells me that we have a U.S. consumer that overspent for the last 6 to 8 months, is making a lot less than what they're doing. We've seen credit cards on the rise. People are getting into debt. People can't afford it. I'm actually seeing people downgrade their living styles. I'm seeing people actually sell off stuff. So that's the only positive. But the downfall is I see an economy that's running out of money that we're getting ready to, I hate to use the word recession, but it's going to be a full-blown recession, not like a little one where it's just a bump. I think it's going to be a full 1 year.
Well, again, this is, when you think about the fastest growing category of consumer debt has been car loans.
Yeah.
And it's just been explosive.
Yeah, I think 1.4 trillion last year.
Yeah.
Yeah.
So what do you see, because like when subprime collapsed, God couldn't get a mortgage in the beginning. So what do you see the state of auto lending here in the next 3 to 5 years?
Oh, man.
Because we're going to go through this, right? We're going to go through this. We're going to repo these cars. Somebody's going to call bullshit on the big three. All of a sudden, used car prices are going to come down, blah, blah, blah. So when that dust settles, what's lending going to look like? This
is my biggest thing that worries me is everybody's like, well, it was unregulated. It's unregulated. There's too many people getting cars. The government should step in. They should do regulations like homes. People don't want to do that because 90% of the people out there in the United States right now cannot afford their cars technically. So if, perfect example, if they go off of what models do they use? So they use debt to income. What is if you're a family, you have 2 kids in college and whatever else, and you want to buy a Corvette for you and your wife and do something special, and all of a sudden they're like, you know what, you can't afford it. Your DTI says you can afford a Toyota Corolla. And so now the banks are stepping in, they're regulating it, and that will pretty much kill the automotive industry. Because our whole goal is to try to sell you as much stuff as they can. Now they're already doing different regulations to limit the what we call like oversells, like warranties, gaps, stuff like that. Anything that doesn't protect the consumer, like the $400 floor mats and keychains, that stuff's going away in the next year or two. So, but the fact of like creative financing, people that that maybe their whole dream is just to have a classic car or an exotic car, they won't be able to afford it. So if that happens, the regulatory hits it. The market is just going to die. It's going to be probably the worst thing ever for the automotive industry.
Are we going to actually see quite a few luxury repos?
Oh, those are the #1 repos right now. Everybody thinks it's like economy cars and everything else. Oh no, most of the cars, Mercedes, BMW, Lexus, Audi, Cadillac, 100%.
Because part of that film, I was like, he just went by a Tesla SUV when you with your drone.
Yeah. Oh yeah, no, that's what everyone thinks. They keep thinking that the subprime sector is like cheap, affordable economy cars. No, these people had $10,000, $15,000, $20,000 down. They're going the whole way. They're buying Mercedes, BMWs, Cadillacs, Audis, Lexuses. That's what they're spending their money on. So that's what we're seeing a lot of the default rates. On top of that, they can't afford the maintenance. They can't afford the insurance. And the average new car payment is $700. The average used car payment is $600. The average payment we see currently in the repo market is between $800 and $1,000.
Okay, so these are people who qualified to make those kinds of payments who are losing these cars.
Yeah.
They're aspirational buyer, so to speak.
Yeah, I've never been able to afford a Cadillac, but guess what? Government gave me 20 grand. I'm going to put it to good use.
So somebody wants you to clarify here. How are you paying more for wholesale and selling less on retail? That's wild.
Yeah, that's the thing is that's why we're getting into the lending aspect is because these dealers are not selling the cars for what they used to. They were getting way over book. So now they're paying retail at auctions and they're selling for retail. There's no gap. So that's why they're doing the extra 150, 160% LTV, because they're going to try to sell you aftermarket warranty, gap, something else to make $2,000, $3,000, $4,000 on the back end. A lot of numbers and statistics.
But that has to work. Somebody
Yeah.
has to agree to buy that.
Yeah, and they do it. Sometimes they force customers, oh, well, you got to do this. You got to do this because of your credit or the bank requires it to get you approved. And so there's a lot of naive consumers out there. But now a lot of the savvy consumers are not putting up with it. That's why the sales have stalled out. People are being more patient, and the more conservative, educated buyers are waiting.
So somebody wants a little bit more clarification on no sales when something goes back to, is that something that can go on forever?
Yeah, so me as the dealer, I can only do a no sale 4 times, and then the auction punishes me. As a bank, they can do it as many times as they want. I've been trying to buy a Jeep Wrangler for my friend that's ran for 3 months now, and I've bid the same dollar amount. And as the book goes down, because traditionally in the car business, the book goes down, doesn't go up. And so now that it's going down consistently, I'm like 25, 25, okay, now 24, 24. Highest bid it's gotten is like 2021, and they owe like $38,000 on it. They don't want to let it go.
I just made it all go away.
Yeah, the bank refuses to get rid of it. But that's what we're seeing.
I just blew up my questions, guys. But I did want to ask about one other thing. You're getting calls from people you've worked with for like years, and they're saying to you, "Lucky, you got to give me this."
Oh yeah, I gotta give them a deal. I gotta give them a free car. I gotta give them 0% interest. I gotta do something special, and it's like I can't do it. It's right now people are in this point where they're so desperate. I've known people that have been looking for cars for over 2 years, and they can't get it. You know, and just like we talked about, like you've been looking for an Escalade for a while, and it's impossible because there's so many people that are so stupid that are willing to overpay for it that we just have to wait for either the world to run out of idiots, which God knows when that's going to happen, and then or the consumer to actually get smart enough where they're going to not pay these overinflated prices.
So speaking of stupid, talk to me about how some of these dealers get financing, and you've been trying to tell them they need to not be sitting on these cars for so long.
Yeah. So
what's standard? And what am I talking about? But what's standard? What are you seeing, and what are you advising?
Yeah, so every dealership, every time you drive by a lot, you'll see all these cars. Just imagine that every car you see is attached to a monthly payment. Let's say each car is $500 to $1,000. They have these lines of credit called flooring lines. That's another thing that Manheim owns, or Cox Automotive. That's one of the other things, so they can control us, so they don't want us to make too much money. They got to get a piece of the pie everywhere. But what they do is they give you high interest, which is usually 10, 15%, plus fees, plus this, plus, and it's designed for you to purchase cars, but your goal is to keep them on your lot no more than 60 days. Because after that, your fees double, your interest doubles, the car costs you a lot more money.
Right. So
traditionally, the way we're taught is to buy the car, put up for sale. On day 45, if it's not selling, lower the price, make a deal, get the car out. You know, we have the saying that you can always replace the car, but you can't replace the consumer or the customer.
Right.
And it's very important. That's how you get market share. But dealers nowadays don't think of that. All they think about is gross. I need to make as much money. How do I bury this poor bastard in a car and they can never get out of it? Where traditional, I want to sell you a car, and then next year you come back and buy another car from me. I don't want to just get in your pocket once. I want the lifetime. I want to buy from you, your husband, your kids. That's the way real professional dealers do it. But now we have all these dealer clowns that popped up out of nowhere, and for the last 2 years, they've been riding a market where cars have been appreciating instead of depreciating.
Right.
So now every dealer is holding on to inventory. I know what it's worth. I can't replace it. I want to sell it for all the money. And these are the guys that are literally going to, I hate to say it, take it in the ass when the market falls out, because as the values of these vehicles drop, these flooring lines like AFC Next Gear, they have the right to come to you and say, hey, you know what? Your portfolio, you owe us $1 million, but it's only worth about $700,000 because we checked the books. So we need a check for the deficiency next week. And if you don't give it to them, they show up at a bunch of tow trucks, they block in your dealership, and they snatch up all your cars and take them away.
They close you down, effectively.
Yeah, I mean, I tell people lines of flooring lines are like loan sharks. They can do whatever they want. They could take your cars, hold them hostage to the auction. If they want to sell them, they sell them. They sue you for the deficiency. They don't care. And then once they do that, they KO you, which means you're kicked out of the car business for life. You can never do it again.
Life?
For life, yeah. So
like the securities industry, you're barred for life.
Barred for life. And then on top of that, if you try to get any specialty license, liquor license, lending license, insurance license, because you're dealing with people's credit, you're dealing with finances, they kick you out. So that's why I tell people it's a big deal. Like, this is going to have major repercussions, because not only are we going to see the banks take a hit, you're going to see a lot of your dealers, local mom and pop shops, they're going to go out of business because they can't afford to take those losses. So just imagine, put this in your head, that you have, let's say, 60 cars on your lot, little small lot, and you're losing about $2,000 of value on each car. You know, times that, what is it, $120,000? A lot of these small businesses can't come up with $120,000 to get rid of these cars. So now, what are they?
That's like a loan shark, come up with cash.
Yeah, they're like, okay, well, if you can't afford this, we're just going to take these cars and get rid of them and just sue you for the difference.
All right, so without naming names, because we don't necessarily have to go there, let's just say in theory that a disruptive car company that happens to be publicly traded is no longer with us, kind of like pets.com is no longer with us after the .com bust. But we do have Chewy.com. And Chewy.com rocks. I mean, it's all I use.
Yeah.
And that was the same basic blueprint. It was just copied and done profitably.
Correct.
Are we going to change the way we buy cars going forward? Are we going to go back to having our asses kicked at dealerships? Or are we going to be able to buy cars the new way we want to buy them through a company that's in business? Maybe yours.
I'm hoping that way. I mean, unfortunately, I think we're going to go the other way. There's going to be two factors. So traditional car sales, used car sales, I believe are going to go back. Now, there's a way where we could do it right, unlike this other company. They were more worried about market share than actually building a correct platform to sell vehicles. But there is a correct way to do that. But what we see coming in the future is used cars are probably going to be traditionally mom and pop stores and a lot of franchise stores. But what franchise dealers are doing now is they're trying to steal the Tesla model, where they're direct to consumers. You can't buy a franchise of Tesla. So what they're all doing now is they're making their EV companies, their electric vehicles, and their regular vehicles completely separate entities, so they don't get, you know, technically they're not screwing over their franchises when they are. And they want to sell electric vehicles direct to consumers. Ford was the first one to fall for the license in 2019, already planning on doing direct sales for electric vehicles. But to offset the dealer's loss, all dealers get to do the warranty work and the service work, which most dealers, all they want to do is sell cars. They really don't want to do the service work.
Right.
And so I think in the future, you're going to see a lot of these electric cars, and these manufacturers, major manufacturers that we've been known for years, are going to go over there and start selling direct to consumers, and they're going to absolutely eat up Tesla's market share. I think Tesla's, when people see the new cars that are coming out, you can go twice the range, better build quality, and half the price, Tesla's going to get their ass kicked.
And like 0 to 60 and nothing. Some of these cars, some of these electric cars that are coming
Yeah,
out.
my friend's got a Kia that's double the range of her Tesla Model 3, and she paid half the price. You know, and I think it's actually cooler looking. It makes these really cool sounds. But when it comes to the used market, it's so many varying factors. Like, I always love to tell people this story. And I told you the other day at dinner, like, Microsoft tried to get in the car business, failed. Amazon said, I was going to do Amazon Autos back in 2015. I remember talking to them. We went over all the factors, all the sliding scales. Just like Zillow tried to jump in buying houses automated online.
Yep.
You can't do it. You get your ass handed to you. So unless you're actually there, it won't be able to work. So I think that's what's going to happen for our future.
What's your dream car?
63 AC Cobra Shelby.
Very nice. Again, I want the very first 2023 Escalade that goes into repos. I want that engine. I really do. Lucky, this has been awesome. Thank you. I really appreciate it.
Thank you so much.
Let's do this again. Let's do it in Vegas.
Yeah, we have to do it in Vegas. We have to do the updates so we can tell everybody we told you so.
Absolutely. Can't wait for that. Thank you so much. And thank you, everybody, for joining me. I will see you next time. This is Danielle DiMartino Booth. Thank you.